Tom Boley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Thursday, April 11th, 2024 edition of Trading Places Live. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for not only the market open, but for the Masters Open. Had put on my Masters hat for this morning. Really excited for this weekend. I'm a big golf fan, so looking forward to what the weekend has in store. I can say that I know the weather's supposed to be a little rough in Augusta this morning. I think first maybe 6 hours or so, 5-6 hours of the tournament might see a lot of rain and storms and wind, and so we'll see how Tiger and the rest of the crew hold up. Anyway, looking forward to that. I was really looking forward to the inflation reports this week, but I was disappointed a little bit yesterday. We did see the CPI come in just a little bit hotter than expected at both the headline and core levels. So both came in at 0.4% when we were expecting 0.3%. Got a little bit of relief at the producer level this morning. So the March PPI came in at a rise of 0.2% versus the expected 0.3. And when we strip out food and energy and move to the core level, they both came in, both consensus and actual came in at 0.2. So no signs of the hot inflation at the producer level. And the annual numbers there are back in line. I mean, we're back at 2%. So it's really about, the stubbornness, I guess, at the consumer level that maybe is sending a little bit of shock through the market. Yesterday's action, obviously you tell me the inflation is going to be higher than expected and we see a jump in the 10-year Treasury yield, then I could pretty much predict we're going to see a drop at the open in stocks. That's just actually using common sense and knowing what I know about valuations, that's the way it should work. Anytime we take a big jump to the upside in interest rates, especially when it's due to inflation, that's going to be a bad thing for stocks. If it's due to a strengthening economy, that's not necessarily the case. In fact, a lot of times that's actually bullish for the market. But anytime we start talking about inflation fears, I mean, go back the last couple of years. When we've had any kind of pullbacks in the market, it's generally coincided with inflation fears of some sort. So yesterday we had a little bit more of that, and we saw the market pull back. Fortunately, we did hold some key levels on a couple of our major indices. We'll see whether or not those continue to hold. Futures are up slightly. They were down this morning. I know the IWM, which tracks the Russell 2000, the small cap index that I like to follow pretty closely. We were down about 1% at one point this morning before these PPI numbers came out. And then we kind of flipped it. And now all of our major indices are showing a little bit of green, kind of like my hat. But excuse me. We'll see how the market starts today, and then we'll kind of go from there. But let's go ahead and take a look at what happened yesterday in the market, and then we'll take a look at what we might expect today. So the Dow Jones, you can see, fell yesterday more than 400 points. It was down a lot more than that early in the session. But as we go back and we look over the last month and a half to 2 months, this area right around 38,400 has provided some pretty good support during this period. So yes, we're down below the 20-day. Yes, we're down below the 50-day. That's never good. It's always better to be above those. But after you've gone through a period of strength and then you sideways consolidate, many times it's a trendless market. During that consolidation, you do lose those moving averages. The question is, when you go back up, do you test the moving averages, fail, and then go to a new low? Just like I've been talking about on the bullish side, when you break out and you go back down, test that 20-day and break out again to the upside, that's bullish. The flip side of that is when you're below the moving averages, testing support, you go up and you fail at the 20, like we did, a couple days ago, 2-3 days ago, earlier this week, and then move down to new lows. That would not be good. So let's watch this rebound. Let's see if we can get back through those moving averages. If we can't and we set a new low, then you're going to have to go look at the weekly charts. We'd have to go to the weekly charts and look at that 20-week moving average. That would be the next key level for me. The S&P 500 dropping 49 points yesterday. That was down almost 1%. Kind of taking out these lows, at least it looks like it here. Actually, when we pull up the chart, you'll see on an intraday basis, we went down and we took out the low from last Thursday. And if you recall, last Thursday was the day that the Minneapolis Fed president, Neil Kashkari, indicated that, hey, we might not have any rate cuts this year. Market for 2 hours sold off pretty significantly. We had a big red filled candle. Yesterday's action on the S&P 500 intraday went just below that, but then came back up and closed above it. We'll take a look closer at that in just a couple minutes, but that was noteworthy. NASDAQ 100 pulling back again. We've been in this level right around, I think I've been saying 17.9, right to 18,000. Watch this area. Well, we finished at 18,011. The 20-day is at 18,104, so we're clearly below the 20-day. We've been doing that here over the last few sessions. But that 50-day we have not lost yet. That is at 17,950. That's only 60 points away. Not very much. So the fact that we kind of rebounded this morning with the PPI, maybe that's a kick save. Maybe we see another intraday move down with I'm not going to be upset if we see an intraday move lower, but then a rally back into the close, leaving a tail down below the 50-day moving average and then rallying back. That to me would be a bullish, at least short-term bullish candle. But what I don't want to see is that close. Then we're kind of forced to move to the weekly chart to look for more intermediate to longer term support in this market. The mid-cap index lost 60 points. That was 2%. So big move down on the mid-caps yesterday. They certainly took it on the chin, losing the 20-day moving average. They'd been holding up better than the other major indices and had been more in an uptrend. But this loss of the 20-day moving average with higher prices, lower PPO, so you got a negative divergence, that sets up the increased likelihood of a 50-day test, which is down just above, actually right at about 2,900. That was also the recent low back in mid-March, right around that 2,900 level. So we closed at 2,945. So I would say we have about maybe 1.5% of potential downside till we hit a key level. You notice over the course of the last 5 or 6 months, we've had a few tests of that 50-day moving average, have not closed below it. So again, if you go down, you close below 2,900 here, then I think you got to move out to the weekly charts because I really don't see anything on the daily until maybe you break out around the 2840, maybe 2830 level, something like that, which would be another 2 to 3% below where we are below that 50-day moving average. IWM down 2.64%. We did close at 200.93, and I talked about 4 levels on the IWM that I'm watching kind of in the near term. Not really sure which one we go down to. I would have obviously preferred holding the 20-day moving average and breaking out. That didn't happen. So recently we went down, we took out that 20-day moving average. It was around 205, 206. We lost that. And then on this move down, we've closed at 200.93, which again, I'll show you this as we look at the bigger chart, but there was a channel line. Yesterday's close, in my opinion, you can draw your channel lines a little crazy, but I think drawing them the way I like to draw them, we had a breakdown of that channel yesterday, and you can see the volume obviously picked up with that hot CPI report and the rising 10-year Treasury yield. I think that was really the big thing for the IWM for small caps. But we do have the Treasury yields coming back down a little bit this morning. We also, as I mentioned, had that more tame PPI number, and we do have the IWM. At least a little bit ago, we were up a little bit in pre-market. I'll give you those numbers in just a minute. But now that's the second level. The third level is this recent low, and I think there's a gap support level over in here somewhere, or maybe it's just the price support level I was looking at. But 198.21 was a level that I was watching. That would be the third level, and then also the 20-week moving average on the weekly chart, which is right around that level as well. So there's a lot that the IWM is trying to hold on to here, and we'll see whether or not it can hold. It's getting really close, though, to some key support levels, at least in the short term. Let's move on over here to check out sectors. Energy, again, top of the leaderboard. In fact, it was the only sector that was positive yesterday. Energy only up 30 cents, but you can see continuing to hold on. Now kind of setting up maybe in a bull flag. So we had this huge flagpole, if you will. And then more recently now, we're just kind of going sideways, not going up, also not going down. I would suspect that we're going to go into some sort of a continuation pattern here. That's normally what I look for after a stellar move like this, either sideways consolidation, maybe a bullish wedge, could form some sort of a triangle. If we drop maybe to the 20 or even a little bit below, maybe we start a ascending triangle, or maybe it's a symmetrical triangle. Something along those lines is what I would expect after such a nice move here on the XLE. Real estate, though, the opposite end of the spectrum. And this is where I start to question the theory of higher inflation down the road. I mean, if the market truly believes that we've got higher inflation down the road, real estate is typically a hedge. So I would expect maybe money rotating into real estate, not out of it. So this is maybe one big question mark, but you can see a fairly big breakdown below recent lows on the XLRE. We'll see if it holds, but the biggest level is not far away, and that's right around the $37 range. That was the low in mid-February, so we really want to try to hold on to that. Technology, also pretty big loser, down 1.23%, continuing to falter at the moving averages. As I look across, and this is similar to the QQQ. Remember the QQQ, I was looking at, I think, 433 as a key support area. Well, you can see why, because we went right down to test that level on the XLK, not 433, obviously, but the support level, which looks like it's right around 204. Finished at 204.71 yesterday, but since gapping up in the latter part of February, we have not lost that level. So losing that could open ourselves up to maybe the bottom of gap support, which would be well below 200, maybe down around that 196, 197 area. That obviously would it would weigh on the NASDAQ and some of the more aggressive areas of the market for sure. Real estate development, you can see right here down 6%. That was the worst performing industry group yesterday, breaking down below the low we had established back at the end of October. So after making a big move to end the year, this the development group within real estate not having a very solid 2024 at all, been downtrending, and even with some additional potential inflation news that might trigger a lot of folks, we're not really seeing the money rotating into these areas to hedge, which a little bit of a head scratcher. Anyway, home builders also dropping more than 5%, back down to its 50-day moving average, closing about 12 points below that 50-day moving average. And that, I don't know if we closed below it in mid-February, but if that wasn't a low close below, then this is the first close below the 50-day moving average on home builders since all the way back in early November when we broke above the 50-day moving average. So that'll be an interesting area to watch today. Obviously, with rates jumping yesterday, and they jumped a bunch. We'll talk about that in just a second. Home builders normally not going to do well when the 10-year Treasury yield jumps, because when the 10-year Treasury yield jumps, that's usually the barometer for the 10-year or for the mortgages and for that market. So anytime we got the mortgage rates, excuse me, moving higher, that normally is going to be a drag on the home building group as a whole. That's what we saw yesterday. Mortgage finance, I mean, these are all areas that you would expect that, hey, rates are going up, could have some problems. We've had a pretty nice push to the upside in that 10-year Treasury yield, breaking above 235, moving through 250 yesterday, or 350, no, 450. Let me see if I can get all these numbers right. We moved through on the 10-year Treasury yield above 450. And remember, we project up to about 465 based on that measurement of that cup, which I'll show you again in a second. Anyway, that move to the upside here, that recent move to the upside has really weighed on the mortgage finance group. So a lot of weakness there yesterday, losing the 50-day moving average pretty easily. Let's move on to that 10-year Treasury yield. And seems like we got everything up to date now here again on stock charts, which is good. But look at that day yesterday with that 10-year Treasury yield moving up. I mean, we started the day at what, 433, 435, and went all the way up into the mid 450s. This morning we hit 458.5, so getting up close to 460 before turning back around with that PPI report that came out. So definitely an uptrend here on the 10-year Treasury yield. I mean, really, no matter how you look at it, we are in a short-term uptrend. Maybe we're going to complete a cup all the way back up to 5. I will be surprised if we go through 5, but hey, anything can happen. We got to be objective, try to remain, impartial, and try and look at these charts somewhat objectively. When the cup broke, I said, hey, 10-year Treasury yield looked like we could go to 465, 466, and we almost hit 460 this morning. And this is only less than 2 weeks since we made the breakout. So clearly we got an uptrend in the 10-year Treasury yield, and that is going to weigh on stocks, particularly small cap stocks. So if we're working on this going all the way back up to 5%, we want to make sure we have those stops in play on the IWM. My hope is that if we get up here to this measurement, that's it, and then we roll back over and kind of get business as usual in a secular bull market. But right now, definitely in the uptrend, we have to respect this. Moving on to the S&P 500. So what I wanted to show you here on the S&P was this was the low from Thursday of last week. We went below it yesterday, intraday, took out that low, but we came back up and held it. So right now we're using that as pretty good support. That is basically where the selling ended on a pretty big day. Again, you look at the volume, we kind of picked up volume. I was a little surprised that the volume yesterday wasn't heavier than it was last Thursday, because remember, that was at 2:00 in the afternoon when Neil Kashkari spoke. So a lot of this volume came in a final 2 hours. Yesterday, we had all day with that inflation report, and yet we held that low, rebounding into the close, and volume was lighter than last Thursday. Anyway, I thought it was a little odd. I would have expected maybe a little bit more in terms of volume and perhaps even the breakdown. I mean, once we break down, we still have the 50-day. We got some gap support, 5,100. It's only a little over 1% away. We're at 5,160 right now, but just want to make sure everyone's aware that would be the next key area. We'd have some price support over here around 5,100, and then also the 50-day. And we don't know what's going to happen. I mean, we reversed. I did say I was going to give you the futures. Let me give you that real quick. So right now the diamonds are up almost 0.2%. The spider up a little more than 1/4%. QQQ, which tracks the NASDAQ 100, up about 0.4%. Back to 440, by the way. We hit 436.28 at yesterday's low. And remember, 433 is the number I'm watching there. IWM up 0.5%. So we have tacked on $1 today, back up to close to 202 this morning on the IWM. I would rather have some sort of a reversing candle where we have a low. Maybe we'll move back this morning, put in one more lower low, and then rebound. I just like to see a lower low. It's just weird to see bottoms form the way yesterday's would have, with breaking down below the channel. Anyway, let me wait until I get to that IWM chart. Make more sense. Here is the NASDAQ 100. You can see these lows coming across. And if I pull up the QQQ, which tracks the NASDAQ 100, that's the 433 that I'm talking about right here. Let me zoom in here. So it starts right around here, and you come across this low and this low and this low. All of these are in the 433s. We haven't closed below 433 though. So yesterday we got down to 436 and change. We got that Thursday low, which is above the 433 level. So if you go below 433, you would take out all these prior support levels, including Thursday's big sell-off. We would lose the 50-day moving average for the first time. So there is some technical damage that would be inflicted if we fall below 433. So anyone who's maybe aggressive and is wondering, okay, where's the level where I might need to rein in my aggressiveness, maybe move to cash, maybe, if you're more risk averse and you want to be in the market, but you don't want to take any big chances, I think that 433 level is one you want to keep an eye on. Again, to me, that's just a short-term level. It's not one where I say, oh my gosh, we're in big trouble, but it's the first crack in the foundation of being in big trouble. Next up, IWM. So IWM clearly did lose its 50-day moving average, and it did that earlier back at the beginning of February. But still, this was big gap down. If anything, though, I've talked a lot about manipulation. To me, I'm much more upset as a bull when I see a big red filled candle like we had last Thursday than I am when I see a big gap down with no follow through to the downside. I mean, we closed almost right where we opened yesterday, down 25 cents from the open. So once the floodgates opened at the opening bell and we took that big hit in terms of the gap, seemed like all the sellers went away, or when there was selling, we had buyers. And so that's the key. And that's why I like to follow the candlesticks. I mean, you notice right at the top here, we had a shooting star. Down here at the bottom, well, we don't know if this is the bottom, but if it turns out to be a bottom, it was a big gap down. Most of the selling coming at the very open. You can't go through a period of distribution by selling off at the open every day. You got to have some selling during the day. Again, if you're new to the show, institutions that need to get out of millions and millions of shares can't do it at the opening bell. It's not enough liquidity. It's got to take place. They hire market makers to sell shares on their behalf or buy shares on their behalf at the best price possible. So you can't put 1 million shares in at market at 9:30 in the morning. There's just not enough liquidity at 9:30 to do that. So this is not distribution. This potentially is distribution. I'm talking about the big red candle from Thursday of last week. So big red candles from here would not be good. Red filled candles. All right. Transportation did make that big breakdown below the moving averages. So any hopes that this was the move that was going to create the breakout to the upside, those hopes are gone, completely dashed. We did make the breakdown here, not necessarily meaning that we're going to, go way lower from here. It's just that we remain in this sideways channel, or not even channel, but sideways rectangular action. 15.4, that's the first level to watch on transports, and 15.2 would be the bigger level. All right, chart of the day. So if you're new to EarningsBeats, first of all, welcome. So glad you stopped by. If you like our show, make sure you hit the like button, subscribe to our channel. That really helps us here at EarningsBeats. And, pass it along to your friends, family, business colleagues, neighbors. When you're out, at that master's party this weekend, probably got some like-minded folks that like to talk about the stock market. Let them know about our show. We'd love to have them. Anyhow, go over to earningsbeats.com if you want to get more familiar with us. Right here, EarningsBeats Digest, free newsletter, name and email address, and we'll get you hooked up. Monday, Wednesday, Friday is when it's normally out. Try to get it out before around 8:30 in the morning. Try to get it out before the market opens. If it doesn't go out before the market opens, you're looking at the culprit right here, because I probably, for whatever reason, just didn't get it done in time. So maybe out later in the day, but I do try to get those out before the market opens as often as possible. Excuse me. If you want to try our service, we have a 30-day no-cost trial. You can click on that button right there and check us out. We do have our third part of our trading series, or this educational series coming up, and it really deals with all the key things that I use in my trading. We've already done the candlesticks. We did the price volume on Monday, this past Monday. Coming up on Monday at 4:30 will be divergences. I'll show you what to look for with divergences, what you can expect after it, and how to manage your risk by using divergences. That's what these patterns are all about, to help you manage your trades or manage your portfolio, manage risk. Anyway, that'll be Monday at 4:30. These two, the one this week on divergences on Monday, and then the following Monday April 15th or April 22nd. That's going to be on Trading Gaps. Both of these, you have to be members of EarningsBeats, but you can be a trial member. So just checking this out for 30 days gets you in not only to the trading room for the next several weeks. We have a live trading room on Wednesdays starting at 10 a.m. But then you also get these two upcoming events, which I think will be well worth the price of zero. I can promise you that. Anyway, check that out. So what's the chart of the day for today? It's not Monday, Wednesday, or Friday, but we still like to do these on our Tuesday and Thursday shows. I pulled up NVIDIA. And the reason I showed NVIDIA, I really like the candle that printed yesterday because we are testing a key support level at 850. We opened below it yesterday. This was the bear's chance to really take hold of NVIDIA to the downside. And instead, we finished near the high of the day. We saw volume, while it wasn't as heavy as the day before, still pretty decent volume. And that is a piercing candle for those of you at the candlestick event that we had a week ago Monday. Candlesticks many times mark reversing or reversals on downtrend. So here's your downtrend. That's really the first reversing sign that we've had over the last 2 weeks. That is a piercing candle and doesn't guarantee us anything, but I believe the odds are greater that we will see a higher high today than we had yesterday. That's all a candlestick tells us. Reversing candle. It doesn't tell us that NVIDIA is going to a new high. It doesn't tell us that NVIDIA is going to blow away its earnings. It doesn't tell us that this is the low for the next 3 years. It just simply says we're going to reverse the downtrend, which means what? We go higher for a day. If we go up today, anywhere above yesterday's high, the reversing candle worked. What you want to find with reversing candles are other corroborating indicators that suggest it's more than just a one-day bounce. And what I would suggest here is that you've fallen from what, 970 down to 850, and we've hit an area where we have been bouncing. So in addition to a reversing candle, you've also got price support. Didn't quite get to the 50, didn't quite get to the PPO center line, but from where we were at 8 and change, we're getting pretty darn close. So in other words, I wouldn't be surprised if I'm right about the secular bull market, and I'm right in that we don't go down a whole lot further from here. I think this is an area where NVIDIA could run back to the upside. So if you believe the market's going lower, that's your prerogative. You might be right. I might be wrong. But I'm just saying from my perspective, if I'm right and the market goes up, that reversing candle from NVIDIA, we might look back in a couple of weeks and say, yep, that was the time to get in. So just pointing out NVIDIA, I thought that was an interesting chart. We got 2 more minutes to go. What do we want to do here? I finished 2 minutes early. Must be something, must be in the air with the Masters. Getting me excited, probably to go watch TV. Put the Masters on. I don't even know if they're playing this morning, honestly. I haven't looked. I know the forecast was pretty grim. So maybe they're even delayed this morning. I haven't looked at anything. So it's going to be a big surprise. Anyway, I don't really have a whole lot to add. I think we're just going to finish a minute or two early today. So I got you out of here before the market opened. I'll give you, what I'll do is I'll give you one last futures update. The Dow now up about 0.25%. The Spider, which was 0.25%, still up 0.25%. QQQ, which I think was up around 0.4, still 0.4. IWM has come back down a little bit, up roughly 1/3. It was up 0.5%. Now it's up 1/3, sitting right now at 201.62. So with that, I'm going to go ahead and end before 9:30. Enjoy your day and have a great day. Happy trading, and let's go Masters. Looking forward to some good golf. Happy trading, everybody.